AMC Entertainment, Q1 2026 earnings. They posted a massive beat on the top line, missed consensus on the bottom line, with total revenues coming in at $1.045 billion.
Right, which is a really impressive 21.2% jump year over year. But, earnings per share is still sitting at a net loss. They narrowed it down to 117.1 million, but it's still a loss.
Yeah, and looking at the immediate stock reaction, shares actually popped about 6% pre-market. The market really zeroed in on their guidance, and that adjusted EBITDA number, which came in way hot at $38.3 million.
Oh, absolutely. I mean, that is an incredible $96 million positive swing from last year. So management is really aggressively selling this narrative of a post-strike theatrical comeback, and investors are just eating it up.
Exactly. So, those are the headline numbers we're looking at today. But on this deep dive, our real mission is to figure out if this comeback is actually sustainable. Because reading through their 10Q filing, well, it kind of feels like when the house lights turn on at the end of a movie.
Oh, yeah. The ultimate reality check.
Right. The magic fades, and you just see the sticky floors and the messy cables holding the whole thing together. You're suddenly staring directly at the raw machinery of the business.
And AMC's machinery is, it's complicated right now. But to start with that massive top-line beat, that $1 billion in revenue, the engine there is undeniably the North American box office. It surged 22%.
Because the product pipeline is finally unclogged, right,
Yeah.
after the 2023 writers and actors strikes.
Exactly. The studios are finally delivering huge tentpole movies again. Management specifically called out Amazon's Project Hail Mary, the Super Mario Galaxy movie Devil Wears Prada 2. The blockbuster intellectual property came flooding back, so the crowds came flooding back.
Right. But, we have to acknowledge that AMC operates with insane operating leverage.
Oh, incredibly high fixed costs, yeah.
Whether the theater is empty or sold out, they still have to pay the lease, run the AC, pay the staff, so they just desperately need that volume to hit break even.
Right, and once they cross that line, the cash really flows. But here's the thing you find when you dig into the 10Q. The studios know exactly how desperate the theaters are for those hits.
The leverage dynamic.
Exactly. Film exhibition costs, the cut of the ticket sales that AMC has to hand right back to the studios, actually rose this quarter to 44.2%.
Wait, up from what?
Up from 43.3% last year.
So let me get this straight. Revenues are up, business is booming, but the studios are taking a bigger bite out of every single ticket.
Yeah, it's the paradox of the blockbuster. When a studio drops a guaranteed billion-dollar cultural event, they hold all the cards, they can just walk into AMC and demand a higher split, and AMC basically has to say yes.
Because they just need the foot traffic to pay the rent. Attendance was up 13.6%, right? Almost 48 million patrons globally.
Right, and the average global ticket was $12.15. But, that's not actually where AMC makes its money.
The popcorn subsidies.
Exactly, the concessions. Food and beverage revenues were a staggering $347.3 million.
Wow.
And in the U.S. market, the average patron spends $8.43 just on food and drinks.
So if you really look at it, AMC is essentially operating as this highly specialized, dimly lit restaurant chain. They use $200 million Hollywood movies as loss leaders just to sit you down and sell you an $8 bucket of popcorn.
Honestly, that is a highly accurate way to visualize the unit economics. The studios own the bait, but AMC owns the concession stand.
But, okay, if the studios have all that leverage and they're already taking 44% of the ticket, why wouldn't they just bypass theaters entirely? Like, we saw them do exactly that during the pandemic with direct-to-streaming releases.
Well, the 10Q actually highlights a massive reversal there. The theatrical window is officially back. Adam Aron noted that Universal and Paramount have joined Disney in committing to a minimum 45-day exclusive window in theaters.
Meaning the movie cannot touch a streaming platform for a month and a half.
Right. It basically proves that the straight-to-streaming model for massive blockbusters is mathematically broken. The studios need that upfront cash flow.
Which is huge for AMC. But, the detail in this report that totally blew my mind was Netflix.
Oh, the Greta Gerwig deal?
Yeah. Netflix agreed to give her new Narnia film a 49-day global theatrical release. That feels like a total white flag moment in the streaming wars.
It really is. For years, tech giants thought theaters were obsolete. But the financial realities finally caught up to Silicon Valley.
Producing these movies is just too expensive.
Exactly. They realized they cannot leave hundreds of millions of dollars of box office revenue on the table. Plus, an exclusive theatrical run is basically the greatest self-funding marketing campaign money can buy.
So by just refusing to die during the pandemic, AMC kind of won the waiting game. They survived long enough for tech companies to realize they actually need physical theaters.
They did survive, but, and this is a really crucial pivot we need to make, just because the top line is recovering doesn't mean their foundation is suddenly rock solid. The 10Q is actually pretty terrifying on that front.
Right, the house lights are fully on now. Because if you look at the liquidity section, management uses some very unambiguous legal language.
Yeah, they explicitly state that current cash burn rates are, quote, not sustainable long-term, unless revenues return to pre-COVID levels.
Which is SEC-mandated corporate speak for, we are still slowly bleeding out.
It's a massive red flag, and the cause of the bleeding is the mountain of debt they took on to survive the shutdowns. They have nearly $4 billion in corporate borrowings.
And this goes back to that $38.3 million adjusted EBITDA victory lap they were taking.
Right. Remember, EBITDA strips out interest payments.
So it's basically saying we're profitable if you pretend our mortgage doesn't exist.
Exactly, because when you actually look at the interest expense on that $4 billion, it was $139.9 million just for this quarter. Yeah. The interest payments alone completely wipe out that core operating profit. They are still hundreds of millions in the hole.
So how are they fixing it? Because the filing outlines some extremely aggressive financial engineering.
They are pulling every single lever. First, they successfully refinanced $400 million of debt, pushed the maturities out from 2027 to 2031.
Okay, so that pushes the immediate crisis wall back a few years.
Right, and they lowered the interest rate on it from 12.75% to 10.5%. Second, they executed a $155.8 million debt for equity swap.
Meaning they paid off lenders with stock instead of cash.
Exactly. Third, they opportunistically sold off shares in Hycroft Mining for a $30 million cash injection.
I still love that fact. The world's biggest movie theater chain owns a literal gold and silver mine. It's such a wild leftover from the meme stock craze.
It sounds absurd, but it actually worked. They originally put in around $28 million, and between past sales and this quarter, they've pulled out roughly $54 million in total cash.
Okay, but we have to talk about the fourth maneuver, because this is the one retail investors need to understand. During this quarter, AMC raised $71.7 million in cash by selling 62.1 million shares of stock.
Right, an at-the-market, or ATM, offering.
Yeah, they just authorized brand new shares into existence and sold them directly onto the open market. I mean, refinancing debt is great, but creating 62 million new shares severely dilutes the current stockholders.
It does.
It's like if you owned 10% of a pizza yesterday, AMC just sliced that same pizza into 50 tiny pieces today. You own a lot less of the pie. So is management actually saving the company? Or are they just bleeding their retail investors dry to pay the bills?
I mean, that tension is the defining reality of AMC right now.
Yeah.
Preserving the company's life and preserving the current shareholders' value are not always the same thing.
Right.
Because look at the math. If they don't raise that raw cash to pay down the debt, they default and go bankrupt. And if they go bankrupt, the stock goes to zero anyway.
So they're trapped.
They are. They're trading equity for time. They are slowly diluting the stock, hoping they can raise enough cash to survive until the box office completely normalizes.
They're essentially using the public stock market like a GoFundMe campaign to keep the lights on, just praying that Hollywood movies get so undeniably good that they won't need life support anymore.
It's an incredibly perilous tightrope. But, you know, as long as the market keeps buying those newly printed shares, it keeps them out of bankruptcy court.
Right. So we've got the booming top line, the suffocating debt, the heavy dilution. But I want to pivot before we wrap up, because the 10Q actually outlines something totally new that doesn't involve financial engineering.
Yes, the launch of Arena 1 at AMC.
Right. Starting in June, rolling out across over 300 U.S. theaters. They're opening their doors to fans of live concerts, not just movies.
And when you think about their business model, this is a brilliant utilization of their fixed assets. They already pay the rent on these huge auditoriums. They own the high-end laser projectors and Dolby sound systems.
And those rooms sit empty for huge chunks of the day.
Exactly. Plus, live music is notoriously inaccessible. If a major stadium course sells out instantly, or you live 500 miles away, you're out of luck.
But with Arena 1, AMC can stream that exact concert live to 300 different theaters simultaneously.
Right. It creates a brand new, highly scalable revenue stream. And the best part, it bypasses the Hollywood studios entirely They aren't handing 44% of the ticket back to Disney for a concert they networked themselves.
It's a fascinating pivot. So to bring it all together for you listening,
Hmm.
we've turned the house lights all the way on. You see the strong top-line recovery driven by the box office and the surrender of the streaming companies. You see the underlying engine of those $8 popcorn buckets.
But you also see the precarious scaffolding, a company battling a $4 billion debt load through highly dilutive survival tactics.
Exactly. It's a frantic race against the clock to see if operating cash flow can outpace the massive interest payments before they run out of shares to sell. And I want to leave you with one final thought to mull over. If this Arena One initiative is a massive success, could the future of your local movie multiplex look totally different a decade from now? Like, what if these buildings transition into decentralized neighborhood stadiums?
Oh, that's interesting.
Right. Imagine heading to your local AMC, not just for the next Marvel movie, but to watch an exclusive global esports tournament or a live Taylor Swift concert, surrounded by 100 screaming fans right in your own hometown.
It completely challenges what a theater is built for.
It really does. The house lights might be on right now, revealing a messy financial reality, but if they pull this survival act off, they might just change how we experience live entertainment forever.
Absolutely.
Well, that is our deep dive on AMC for today. Make sure you hit follow on the show for our daily earnings coverage, and we will catch you on the next one.